When we read the Fed's statement, not very much has changed at all. And when we read the Fed's forecast, other than the dot plot for expectations of policy, not very much has changed at all beyond the growth and inflation expectation for the current year. So as concerned as the Fed might be, the majority on the Fed still very much is looking forward to a moderate growth and low inflation outlook. So I think that what the Fed chair is trying to do right now is walk a very delicate line. If we recall back at the time of the last tapering, it was preceded by a paper, a Jackson Hole by Michael Woodford, in which he argued that guidance was a potent tool of monetary policy as long as even when the central bank had interest rates down around zero. Because if people expected the Fed not to move, they would accelerate their investment spending and consumption spending to take advantage of the promise of low interest rates. And I think Fed Chair Powell is very conscious of that. He's trying to keep the storyline focused on 2023, 2024 before the first move out of the Fed. But at the same time, he has to acknowledge that the Fed is aware that there could be inflation risks. And if that does happen, the Fed will be there to take care of whatever has to be taken care of. I think he's walking a very fine line, but the name of the game here will be to keep the guidance looking forward very, very far ahead.
Yeah, it's very interesting. I mean, you all the way through have basically made the case that you agree with the transitory line. And even as Powell acknowledged that there have been notable rises in price pressures, he still sticks to his argument that these will wash out as the supply bottleneck eases. Let me ask you, how useful do you think the 30-year Treasury yield is at this point as an indicator really of how transitory that inflation story will be? Because at the moment, the 30-year is behaving just as the Fed would hope it would behave given its analysis.
Yeah, I think there's a lot of divergence across markets and across market participants about what is really happening here right now. Are we really going to see an acceleration of inflation? On what basis, are we looking for that? On what data are we basing that assumption? And the market is, at least the bond market, is not going for the assessment that inflation is lurking around every corner. And when you look at the data, you've got 1 or 2 months of accelerating prices, and that's it. That's really all you have. You look at the real data, and we're going to get an update on personal consumption spending this week. Your incomes are down, spending is down. The housing data are doing okay. The jobs data have sort of stalled out a little bit. When we look across the board, all the indicators we're looking at suggest that after the burst of post-stimulus transfers to people's pockets, the economy is slowing down again. And I think maybe a month or two from now, when oil price basis effect is out of the CPI, when the spool up insufficiencies of supply have worked themselves out and prices have stopped accelerating again, when used car prices stop going up and biasing the entire CPI upward, the case for a hawkish Fed and for inflation worries is going to be much, much harder to sell. And that's what the bond market is telling us. They're doing what the Fed wants them to do, looking through the noise.